Hi once again everybody, and welcome to another episode in the Perfect Property Investing series with me, Sarah Flynn from KAF Developments. So this week I thought I would spend some time talking to you about the various lending options that are out there when you are thinking of buying and investing in property. Now, it may seem like a minefield, and there are genuinely thousands and thousands of lenders and products out there, and you may not know where to start. Now, from my perspective, I would say the best thing to do is to get a mortgage broker, because they are the people that are going to be able to advise you best on what the best product is going to be, dependent upon what type of property you're buying and what the strategy is, etc. Now, even though it seems complicated, I am hoping that today I will break lending down for you into three key areas. So for me, I think that the three key aspects or areas of lending are: 1, a buy-to-let mortgage; 2, a bridging loan; or 3, commercial mortgages. So we will go through each one of them in detail, and we'll start by talking about a standard buy-to-let mortgage. So what is a buy-to-let mortgage? Well, this would essentially be where you would purchase a property with a mortgage that would be specifically, the product would be specifically for a buy-to-let or a rental, like an investment property. And that they are special products that they do on the market that certain lenders do, well, lots of lenders do, to enable you to purchase an investment property. Now, what is normally required is a 25% deposit on a buy-to-let mortgage product. Now, that does vary, and the market has got a bit broader and wider. And they may find that some lenders now are quite happy to take even up to just a 10% deposit on a buy-to-let property. But generally speaking, most lenders are comfortable with you giving them a minimum of a 25% deposit, and therefore you would get the mortgage for the other 75% of the purchase to make up the 100% purchase price. So when you purchase a property and you're going for a buy-to-let mortgage, there are 2 types of buy-to-let mortgages primarily that you can have. The first one is a capital repayment mortgage, which would be no different to a mortgage that you've got over your main residential house if you've got a mortgage already. So you would be paying off the capital of the property month on month, and a little bit of interest as well. And at the end of the repayment term, whatever you choose that to be, the property would be paid off in full. Now, the other sort of mortgage you could get is a buy-to-let interest-only mortgage. Now, my suggestion, if you are just starting out, is that is possibly a route that you want to consider. So how does this work? Well, what you would be doing is just paying off the interest accrued on that mortgage every single month for the repayment term, and not any of the capital. So you need to be aware that it obviously does mean that at the end of the repayment term, when you get to the end of the 25-30 year period, whatever it is that you've got the mortgage for, that the capital, so the original purchase price of the property, will still be outstanding, and you will need to pay that off. And it depends what your long-term strategy is as to whether that's going to work for you. So if it is that you want to keep the properties forever and you're creating maybe generational wealth and a generational portfolio, then you might want to look at a capital repayment mortgage, because if you're going to keep those properties forever, ideally you would want to be getting them paid off so that at the end of those terms you own all the properties outright, and therefore you've created a large amount of capital for somebody to be able to live off. The other school of thought is obviously you might want to do it a different way, where you are just paying the interest, as I say, every month for the repayment period on an interest-only buy-to-let mortgage. And then obviously at the end of that repayment term, you might look to sell all your properties. So it might be that you want to, the ultimate goal is to sell everything and take all the cash at the end of it and keep all that cash to live off. And that's another school of thought and another way of thinking. And also, don't forget, you will have had capital appreciation over the duration of the time that you've had the property. So you will probably stand to make more ultimately than when you first bought the property as well. So they're two ways to think about it, and you have to look at your long-term goals. Now, one of the short-term advantages, obviously, of having an interest-only mortgage is that it gives you a much higher cash flow. And I know I spoke about this in my buy-to-let video that I did a couple of weeks ago. And that, again, is something that you need to think about. If you are looking to build cash flow in the early days, then an interest-only mortgage is definitely the way to go, because it helps keep those repayments down, and it in turn would obviously make your profits on a monthly basis a lot bigger, because you wouldn't be paying out as much. So it really depends what you want to do and what your long-term goals are. And don't forget that you can switch products pretty much at any time. So generally speaking, on a mortgage, you would be tied in for maybe somewhere between 2 to 5 years, depending upon the deal. And at the end of that period, you can then switch to a different mortgage. So what some investors do is they start on interest-only mortgages to be able to build that cash flow and to be able to build the portfolio. And then maybe sort of 5-10 years down the line, they would then switch off those products onto capital repayment products and start to pay the properties off. So there are lots of different ways to do it, and it's entirely up to you what you think is going to work for you. So the second way that you could purchase a property, and the second main pool of lending, is bridging. Now, when somebody says a bridging loan, there is a sort of historic thought and panic in people's minds that it's huge interest rates, it's this really scary loan that you have to pay off in a really short time. And to a degree, some of that is true, but it is an exceptional way to buy property if you are deploying the right strategy. And I'll explain what I mean by that. So from a bridging loan perspective, if, for example, you are doing a flip and you have bought the property below market value and you've done all your numbers, and you know that once you've done the refurbishment costs, you're going to create, let's say, £50,000 capital appreciation in the property, and that will be your profit. You will obviously have the reassurance that the bridging loan should quite easily be paid off once you have done the works and sold the property. So obviously you need to be checking the interest rates, because they are high, and a lot of them are compound interest rates, and they are accrued on a monthly basis. So you do need to check the terms, and you would need to be going to a bridging broker or maybe a finance specialist to get one of these products. But they are great products to buy flips quickly. Generally, you would find that a bridging loan would be organised much faster than a mortgage. I have known them to be organised in as little as 5 days, which sounds phenomenal, but they really are. They are really that fast. They can be done at speed. And if you want to crack on and you've got deadlines for projects, they can be a really good way to purchase things. Now, another reason, apart from the quickness, that you may want to use a bridge is because sometimes it means that if you have got other assets already, for example, but you've got no physical cash to be able to purchase a property, you can use a bridging loan to secure the money against your assets already. So essentially, you may be in a position where you can purchase a property and lend 100% of the costs. So what I mean by that is that you may be sat in a house now that's worth £300,000, for example, and your mortgage might be clear, so it's an unencumbered property, you own it outright, and it's your main residence, and you decide you want to get into property, and you have seen a property that you like, lovely little buy-to-let, and it's £150,000. Now, there is more than enough value in your property already to be able to secure the bridging loan against it. So some companies out there will quite literally put a charge over your main residence for the time that you are using the bridging loan, whatever that term may be that you've decided, and they will then loan you 100% of the money to be able to purchase that property. And there are even some very specialist bridging companies out there that, if they can see the value in a project and they know that through the refurbishment works you are going to be creating massive capital appreciation, they will also lend you the refurbishment costs as well. So as you can see, they are a great tool, bridging loans, to use in some circumstances, because it sometimes enables you to be able to leverage capital that's tied up in other assets. And then the final lending is commercial mortgages. Now, this is obviously generally speaking, thought of as buying commercial property. And that is true. You would get a commercial mortgage if you were buying commercial property. So if you were buying like a shop or a warehouse, for example, then you would possibly look to get a commercial mortgage. However, you can also get a commercial mortgage on some residential properties. Now that might sound a little bit confusing, and I won't go into too much detail in this video because I will be doing a whole video in itself on commercial property and commercial mortgages. But there are some instances where you would use potentially a commercial mortgage as opposed to a residential one, even though the property is residential. An example of that might be if you have bought a property and you have renovated it into a 7-bed or over HMO, so anything from 7-bed and over is classed as a commercial property from a financial perspective, and therefore you can get commercial lending on it. Now, why is that advantageous? Well, generally it is because that a commercial valuation is worked out very differently to a normal standard bricks and mortar valuation on a residential property. So often what you will find is that you will get a much higher value on a commercial valuation than you would on a standard bricks and mortar valuation. And that can be important when you're thinking about the exit strategy. So if you have bought the property, let's say that you've bought it with a bridging loan and you've done the refurbishment works and it's become a 7-bedroom HMO, then once those works have been done, it might be that the property is only worth 330,000 at a bricks and mortar valuation, but as a commercial asset it's worth £450,000, and that is a real live example of something that I've done recently. So it's important that you can see the clear differences there, because there are some advantages in terms of creating extra value. So how is a commercial mortgage worked out, and why would you get such a higher valuation? Well, because unlike a normal bricks and mortar valuation, which is based on comparables in the area and other strengths such as the style of the property, the size of the property, etc., from a commercial valuation perspective, it is generally based on the strength of the rent. So what do I mean by that? Well, if, for example, you'd created a HMO and it was bringing in £4,000 a month gross capital rental income, then what would happen is the commercial valuation company would times that number, that monthly rental figure, by 12 to get the annual figure. So in our case, it'd be £48,000 a year. And then from that, they will then times that annual figure again by either 8, 10 or 12. And that will give them a valuation of the property from a commercial perspective. So the reason that the commercial property companies have this commercial multiplier of either 8, 10 or 12, so 8, 10 or 12 times the annual rental figure, is because it depends on what they deem to be the strength of the rental overall. So what is the likelihood of that property being fully let all the time and bringing in that annual rental figure? And the more they deem, or the stronger the case, I suppose, is that that will be full, the better commercial multiplier you will ultimately have. So let's just say, to make it easy, that in our scenario that the commercial mortgage company has said that we can have a commercial multiplier of 10. That would mean that in our example of a £48,000 a year gross rental income, the property is now worth £480,000. So that is probably going to be vastly more money than this 7-bed property would be normally. So that exactly in the example that I'm giving, you can see immediately how I've illustrated there some of the benefits of having a commercial mortgage if the circumstances suit. So at a high level, that has been the 3 key aspects or areas, I suppose, of lending from a property investment perspective. I hope you've enjoyed the video as ever. If you've got any questions, of course, please get in touch with us at www.kafproperties.co.uk, or you can find me, Sarah Flynn, on all the major social media platforms. So again, stay safe, stay well, and I'm sure I'll see you again soon. Bye bye.